Video, I'm going to show you how to win as a new trader. Professional traders actually take a large amount of losses. However, they are usually trying to catch trends and adding to winners. The problem with new traders is building confidence, and that is a crucial part of the psychology of trading that keeps new traders consistently making money. They discover a million indicators and thousands of strategies, back test them, live test them, take repetitive losses, and then change the strategy. The proper risk to reward, where to place a stop, how much risk to take. The answer is quite simple. In order to become profitable fast, first you must understand that you can do it, but your equity curve will be very small. And this is the best thing that you can do. What I mean by this is instead of taking 5 losses in a row and blowing an account trying to get a 5R, you should have a tight strategy, repeatable with a set rule list and a simple 1.5 to 1R. If you can have a slight equity curve with a 1.5, then you can continue to refine until your smooth R is a 2.1, then a 2.5, and so on. The reason this is so important is because you will win more trades, get more confidence, stick to your strategy easier, and when you deviate from the strategy because it has become habitual and calculated, you will immediately know that you messed up entering the trade, and in my experience are quicker to just cut the loss fast. This allows you to have more confidence, collect super important data that will help you become a better trader. Okay, so let's get into the trades I took yesterday. First, I want to find a downtrend or an uptrend with an order block, preferably some fair value gaps, and repetitive losses before a continued sell-off. So here we have an order block. Retests, I mark that area out, right? I drag this down, and I usually will cut off. This is the lowest point of liquidity I'm looking to get pulled before an entry. This is a middle test, a high test, fair value gap, order block. So I'm looking for aggressive buying into that area, preferably 20 to 30 minutes after London Open. Sometimes it happens a little early, and yesterday it did. So on Monday, I had these areas marked out. I had seen a tap into this. This is a liquidity pool area. So is this, and this with our order block. So what I'm looking for, I'm specifically looking for during session open or during a high volume period to find a retail trap. A retail trap is an aggressive push into a selling order block, and I want to sell the exhaustion. Now, an exhaustive move for me is an aggressive push up, a very weak pullback. Sometimes it looks a little bit like a U, and as it starts to break the high, I will sell small positions. When it does break the high, I will continue to sell small positions, and on the failure, I will start to sell. Okay? As it starts to push down, I'm looking for liquidity to get taken out on the upside, okay? And what that means here is we have an Elliott wave, 1, 2, 3, 4, 5. Okay, so now we're getting into an exhaustion time frame. Here we can see it broke down and it held underneath this level, and that's when I took my first trade, which was a loss. So as this pushed up and pushed up here, I sold with my stop above this, and I was stopped out, which is fine because it's a very small position. And then I added back in because I had seen it actually pulled this liquidity, and my stop and targets were liquidity pull 1, right? This is structure, right? I'm looking for retail traders to be loading in a lot of volume. Algorithms are going to look to take out that volume if they want to take the trend higher. So I will at least be able to exit on my TP1 almost all the time. TP2, not as often, but still a high amount, and then TP3 is a complete pull of the lows. The reason this happens is because algorithms trade the market, we all know this now, and they know where the orders are, they know where the stops are. In order for the market to continue directional, it needs to pull on liquidity. So all we're doing is we're just betting that the most obvious area of liquidity is going to get taken out, and I'm looking for an exhaustive move, okay? So on the 1 minute, I am looking for an exhaustive entry into my area. Okay, and I have my levels marked out. And here is my first indication, right? We get a push up, a pullback. It's a pretty shallow pullback. It doesn't really pull a whole lot of liquidity, and then it pushes up. So I take a trade as we break above this area right here with my stop and targets with a 1-to-1, and I'm looking for an excuse to move it to a 2-to-1 as soon as possible. But I'm going to take small positions here because I'm not entirely sold yet. Here again, we have a pullback, does not take out any liquidity. We still have a primary level here. We have our primary level here and here. So as this pushes up and starts to fail down, I sell again, with now that I have added, this has got a 2 to 1. So my trade has to look like it's a 2 to 1, okay? So on my add, we move everything to a 2 to 1. So this is my stop on the 1 to 1, and now this is the 2 to 1 trade, okay? Now I am of course looking for a pull in the primary area of liquidity, and as it starts to move into TP1, what do I do to make sure I have a better smooth RR? I move my stops down like so. So my 1 to 1 and 2 to 1 have now become a 3 to 1 and a 10 to 1. Okay, so as it moves into TP1, I take 25% of the trade off. Hits TP2, I take another 30 to 40% of the trade off. So I have about a quarter left, and I'm looking for that TP3. And sure enough, just in a short amount of time, we get that. So on the second entry to exit, we were in this trade for about 2 hours before we got our first, second, and third profit target. Now, Australian against the dollar. Okay, again, this is a bit of a strategy 7 entry. So strategy 7 is just an aggressive push up, followed by a liquidity pull, and then a second push up that tends to follow through. So my target is a break of the median, which perfectly works out to a strike area, pull and liquidity, and a strategy 3 entry, which is just a retest of a bearish order block where there was repetitively weaker tests against it before a sell-off. So here I have an entry, it doesn't quite get to it, right? I move my stop up and I get stopped out for break even. On this, we have actually pulled the daily liquidity, and now we're starting to push up. So I take a 2 to 1 trade that looks just like this to make sure that I don't get ticked out, and I watch it. As it starts to push up, I'm comfortable moving my stop up to here, and this immediately becomes a 6.67 to 1, which we get. And then we get our strategy 3 entry. And it's a strategy 1 failure. So a strat 1 failure, we have an aggressive push up, a weak pullback, a push up, and in this event we actually did break the highs here, but we get another shallow pullback, a push up, and right as we're pushing up and breaking this and rejecting, I sell with my stop a 2 to 1 away. And as we start to reject and come back and take out these lows, anything could happen at this point. Liquidity has been pulled and we could continue an uptrend. So it's time for me to move my stop up to here to make sure that we don't take a big loss. And this has now become a 4.5 R. So now we look for primary structures. Where is a retail trap, right? On an aggressive push up, we have an obvious area where people are going to be putting their stops, and this can be our TP1. Okay, we have a clear structural point. This is our TP2, right? So we're going to take probably 50 to 60% of the trade off in this area. And then the obvious low is here. And there are so many times when I see an obvious low get taken out just for the trend to continue higher. And sure enough, we actually started to push back up. But what happened first? We took out the low of this. Okay, and that could be our final target. So just like that, in only a few minutes, we were able to get a 7 to 1 R trade. The realistic issues with this, or the realistic issue with retail traders is you're trying to get 5 to 1, 6 to 1 trades. I am not here to predict the market. I'm here to interpret it, and I'm looking for exhaustion, retail traps into an aggressive selling area. We're in an aggressive downtrend. I see aggressive buying volume right into a structure point, and I know a lot of people are going to be buying, active buying, and I'm looking for absorption. And when I see very weak pullback and then continual attempts, I am anticipating a lot of buying volume is going into this, and the probability that we are going to sweep lows is extremely high. All I need to do is look for high probability places to take profits. So we have lows here, we can take profits here, and we have lows here and here. These are retail trap stop areas, and these are the low of the day, okay? All we have to do is look for exhaustion, and we can trade it accordingly. So again, strategy 3 we have 1, 2, 3, 4, 5 tests, a fair value gap, and an order block right here. So order block, fair value gap, 1, 2, 3, 4, 5 tests. Aggressive buying into this area, a shallow pullback, and an immediate attempt to continue higher. People are buying into this with their stops down here, and it immediately tanks, and it ends up being a great short trade. Okay, so you can see this is a retail trap. It's an exhaustion pattern. People buy this because they are told to buy breakouts and flag patterns, and they don't work. Okay, when I see YouTubers and stuff who say, oh, I trade breakouts and stuff, I do not believe them. Breakouts fail 50% of the time. Your stop has to be quite far away, and if it's not, you're going to get stopped out a lot. It is not a successful trading strategy. Okay, here is a flag pattern that actually did work out. Okay, but again, I am not willing to trade flag patterns because my risk reward tends to be skewed. Now in a situation like this, yes, we did have a great breakout. You could potentially buy it here, putting your stop under the lows, and as it takes out these highs, what I would personally do is move my stop up to here. But still, the 0.83 targeting a test of the highs, you don't know how far this is going to go. Flag patterns tend to be head and shoulders. So what is this right here? A shoulder, a head, a shoulder, and a failure. Okay, so I do not trust flag patterns. Instead, I'm looking for what I call strategy 1, which is just exhaustion, a push up, and a pretty immediate attempt to go higher with no significant pullback. So in a situation like this, as it starts to break the highs, I am willing to take small positions that this is going to fail, and as it does confirm the failure and starts to come down, a retest and a failure, I can add to the trade, and I can move this stop to break even and this stop down, and now I can target the liquidity and have a really great RR. So on this, I'm break even, and on this, I'm risking a 1.4 for my first TP. In a situation like this, because this is my biggest winner at this point, I'll probably scalp this trade, exit at TP1 for a big win, and not have to worry about the trade at all. And now I can just move my stop down to where I think we might actually get a great pull on liquidity and take it for the whole run. Okay? So those are my 2 trades from yesterday. That's the recap. I hope you guys appreciated the video. Please like and subscribe, and I'll see you guys in the next one. Peace out.